Welcome to PIMCO Pod. In this episode, we discuss how leverage and complexity are gaining ground in today's late-cycle markets, signaling caution, not crisis, and underscoring the value of diversification and risk management. Stay tuned after the conclusion of the podcast for additional important information. The Credit Market Lens, The Return of Financial Engineering, Not 2008, but Not Nothing, by Lotfi Karui. One observation in PIMCO's secular outlook that generated a lot of interest was the notion that financial engineering was poised to accelerate. We aren't suggesting a replay of the excesses linked to mortgage markets and other areas that defined the pre-GFC era. Rather, we're observing a familiar feature of late-cycle markets. When spreads compress and traditional sources of return become scarce, investors and intermediaries often respond by creating new ones. Leverage, ratings arbitrage, liquidity transformation, and a growing willingness to embrace complexity and illiquidity are becoming more visible across parts of the financial system. So where and how are these financial engineering tools potentially leading to excesses? What follows is intended to be illustrative, not exhaustive. The examples are not necessarily linked to one another. They are separate expressions of the same underlying dynamic. Individually, most are small. Collectively, they point to financial engineering re-emerging as a defining feature of a maturing cycle. Leverage in the system is rising. Securities margin balances, a direct measure of leverage employed by equity investors, have picked up meaningfully in recent years. As a share of total equity market capitalization, these balances remain below prior cyclical peaks. But the pace of increase over the past 2 years is notable. Margin leverage usually amplifies market moves, and perhaps more importantly, margin calls tends to be triggered by market stress rather than by deteriorating fundamentals, forcing sales into falling markets and increasing the risk of more widespread deleveraging. Aggregate hedge fund borrowing points in the same direction. Federal Reserve supplementary flow of funds data show that hedge fund prime brokerage borrowing has roughly doubled since late 2022. Leveraged ETFs continue to grow at a rapid pace. SEC regulations implemented in 2020 streamlined the ETF launch process and materially lowered barriers to entry. This in turn accelerated the proliferation of increasingly specialized products. Among them are leveraged ETFs that embed daily reset leverage into vehicles accessible to a broad retail investor base. For context, total AUM, assets under management, in U.S. leveraged ETFs has more than quadrupled since 2022. While these products generally function as designed, many investors likely underestimate the path dependency of compounded returns and the speed with which volatility can erode capital in a drawdown. Leverage on leverage is back. Borrowing is increasingly being layered on top of already leveraged assets. Net asset value, NAV, lending and subscription facilities, which allow sponsors to borrow against fund assets or investor commitments, are themselves being securitized, adding fresh layers of leverage within the system. Within the broader market for asset-backed securities, ABS, these structures remain very small, at least for now, at around $1 billion in total balance, by our estimates. Similarly, collateralized fund obligations, CFOs, represent another form of leverage on leverage, securitizing portfolios of limited partner stakes in private funds that themselves may employ leverage at either the fund or portfolio company level. Another example is total return swaps on equity CLO, collateralized loan obligation tranches, which have also gained popularity. Banks are on a firmer footing than pre-2008, but more enmeshed in the financial system. The dramatic rise in bank lending to non-bank financial institutions has been well documented. Banks have increasingly become providers of leverage and liquidity to alternative asset managers through subscription lines, NAV facilities, and warehouse financing. But the linkages run deeper. Banks have also materially increased their reliance on significant risk transfer, SRT transactions, to shift credit risk on loan portfolios to insurers and institutional investors. In some cases, the investors ultimately exposed to the underlying risks are affiliated with the same private equity firms that sit elsewhere in the financing chain, as borrowers or sponsors. The result is an ecosystem in which risk is not so much spread across the system more broadly as redistributed among closely linked participants. This means the diversification benefits SRTs are intended to provide can become less meaningful when exposures remain concentrated within a tightly connected network. Put differently, risk may appear to move off bank balance sheets, but at the system level, it often remains within the same financial orbit. Maintain a healthy perspective on financial engineering. These developments matter because financial assets, mainly equities, and housing have been the primary drivers of household wealth creation in the U.S. since the GFC. Thus, a shock that materially impairs either channel could potentially spill into household balance sheets, consumption, and ultimately broader financial conditions. That said, perspective matters. The excesses highlighted above remain small relative to the size of global capital markets. Take leveraged ETFs, for example. At roughly $225 billion in total AUM, they represent less than 0.5% of the roughly $75 trillion U.S. equity market, according to Bloomberg and SIFMA, the Securities Industry and Financial Markets Association. Moreover, today's structures don't resemble the toxic combination of excessive leverage, severe asset-liability mismatches, and housing market speculation that preceded the GFC. Therefore, the parallels should not be overstated. But the emergence of these structures does point to a cycle in which the marginal returns are increasingly being manufactured rather than earned. And structures built under such conditions rarely reveal their fragilities until there is a negative liquidity shock. As noted in the secular outlook, we do not view these risks as systemic, but they bear scrutiny. Thoughtful diversification and risk mitigation may make sense for investors as financial engineering evolves. Thank you for listening. That was The Credit Market Lens, the return of financial engineering. Not 2008, but not nothing. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.